Lori, take it away.
Thank you so much. Thanks for those kind words. It's so nice being with you here today. And I'm so happy that I'm actually moderating this panel on revolutionaries because I specialize in that. I manage and oversee the Disruptor 50 list for CNBC, where we're constantly looking. We spend all year looking for disruptive companies and disruptive technologies to feature and put on our list. And I'm happy to say that among them this year was SoFi, last year was Lending Club, so I feel like we're really on the money looking for breakthroughs in the industry. So with that said, I want to just go over some of the key points Crowdnetic has gone through today with you earlier in the day, because I think that these are the trends that's really pushing the industry and causing the revolution that we see unfolding. And sometimes when change happens so fast, it's almost hard when you're right in the middle of it to really grasp what's happening around you. But think of this. Think of some of the points that we made today during the discussion. More small and medium-sized businesses are turning to alternative lenders versus banks despite low interest rates. Just think how low our rates have historically been over the last couple of years, and yet there's been no surge in bank lending. Small businesses create 70% of the jobs in America, but traditional small business bank lending still is down from pre-recession levels. $300 billion is the market for small business loans. Think of how huge that market is. Yet 50% of small businesses don't receive any financing they apply for in the first half of 2014 last year, according to the Small Business Credit Survey by the SBA. The point is, it's tough getting a small business loan, and it's not getting easier. And therefore, small business owners are fed up with banks. They don't even want to bother going to a bank and try to get a loan. They rather go to non-bank lenders. And the non-bank financial system is estimated at $3.2 trillion in the United States and $15 trillion globally, according to the Bank of International Settlements. That includes P2P lending. So with that said, looking at the forecast for the industry to grow to $1 trillion by 2025, it's no wonder venture capitalists and others are so excited about the prospects of these types of companies. So with that said, I'd like to introduce our panel, and I'd like each CEO to please describe the lending niche that their company is rushing to fill and the market opportunity it sees for its business. So let's start with Brock Blake.
Brock Blake, founder and CEO of Lendio. Lendio is a pure place small business loan marketplace. What I mean by that is, or pure play. What I mean by that is we are not a balance sheet lender. We describe ourselves similar to maybe how Kayak is for travel, Lendio for small business loans. We have all the small business loan options on one platform. Business owner can come and we can match them up to the right loan product. Also, before we get too far, we have to say congratulations to one of our panelists down here. Candace is going to kill me for this, but was engaged over the weekend.
Oh, congratulations.
We're glad to be here.
Thank you so much, Brock. Okay, I'll go next. Hi, I'm Candace Klein, and I just got engaged this weekend. I run strategy for Dealstruck. Dealstruck is a balance sheet lender. We started off actually as a peer-to-peer lender in 2013. We raised our first $10 million, $100,000 at a time from high net worth individuals, and that was quite a bit of brain damage. And we had the great fortune of bringing on a hedge fund in the summer of 2014, and now we have bought back all of our loans, and we are 100% balance sheet play. Our differentiator in the marketplace is that we serve the mid-prime borrower, so we're typically graduating borrowers out of factoring or merchant cash advance, and then they're with us for about 2 years before we graduate them onto a bank loan. And we provide those borrowers with three main products: with a term loan, with an asset-based line of credit based on turning invoices, and with an inventory-based line of credit. Happy to answer more later.
Great. I'm sorry, Adam.
Oh, that's fine. Jeffrey Rogers?
Sure. Jeffrey Rogers, CEO of LiftForward. LiftForward, we're a direct lender as well, but we don't hold our risk for our loans. We are somewhat peer-to-peer. Our investors are all institutional, so not necessarily a peer. We have 3 institutions on our platform now, the largest of which is Veraduro, which we just closed a $250 million loan facility. Our loan product is very broad. We're in about, I would say, 60 different industries, and we do up to $1 million, which is a little unique to go that high. And our average loan is about $150,000. We will also go out to 36 months. There was a question at the last panelist. We will match our capital with the term of the loan.
Kathryn, Petralia with Kabbage. You guys already heard from me, sorry, but I'll try to tell you some different fun stories this time. We have two businesses, direct lending business and a platform lending business, where we license our platform to third parties, generally banks. But for this purpose, we'll talk about the direct lending business. We provide between $5,000 and $100,000 in revolving lines of credit to our small business customers. And we've been doing that for about 5 years with a focus on automation and technology that allows our customers to get through the process very quickly and allows us to make ongoing decisions about those businesses.
Stuart Law, the founder and CEO of Assetz Capital in the UK. We're a traditional peer-to-peer marketplace lender, historically funded by retail money, so about $150 million lent so far using retail only, but we have a process we're about halfway through, onboarding about currently $900 million of funds, institutional money, to add to our retail funds. We're secured business lenders, and we lend to small businesses, but starting at about £100,000, £200,000, $300,000 per transaction, and up to as much as $5 million per transaction in the largest case.
Terrific. Well, let me ask the group, how are you trying to streamline the lending process for the borrower and the lending institution?
I'll go ahead and take it. So as a marketplace, our focus is to provide an easy experience for the business owner. So we provide technology, and we are gathering data from that business owner on the front end. So we pull bank statements up front, we pull credit, we look at tax returns, all from third-party data providers, and then we use that information to match them up to the appropriate lender. So whether it be Kabbage or Dealstruck or other lenders or bank lenders. And then we ideally will create an API integration with that lender where we'll send that application off to the lender, they'll underwrite it and then send it back to us, and we compile those multiple offers and provide it in front of the borrower so they have options to choose which is the best fit for them. So we're leveraging technology and data sources to make it easier for the borrower and a lower customer acquisition cost for the lender, because they're only looking at deals that ideally meet their credit box.
How long does such a process take typically?
It depends. Well, I mean, it's very quick. If we can gather all the data sources if the borrower is willing to give you all the data sources online, then it happens very efficiently. And then it also depends on the technology of the lender that we work with. And I'll give Kabbage a great shout out. They, I believe, are the most technology advanced out of the lenders that we work with, and other bank lenders that we have on our platform they're not sure what the word technology actually means. So that's a little bit slower, longer process.
Yeah.
I'll just jump in there. It's really all about the customer experience. So what we try to do is make it simple. We keep the application down to 15 minutes or less, and if we can get the data from some other type of API integration with our partners or some public source, we'll pull it there rather than get it from the customer. Customers that come to us too, typically they've already either went to a bank or have dealt with the bank or have an SBA loan, and they don't want to take a 2-month process. So for us, it's about giving them certainty. So for $150,000 and under, we have a same-day approval and funding. And then loans up to $1 million, we typically fund within 4 to 5 days.
Because our product is our larger product is our line of credit product at this point in time, it's a much more complicated product than the term loan product is. We can underwrite our term loan product much more quickly, but with the asset-based line of credit and inventory line of credit, it does take about 10 days from the date that the application is sent to us until the date that we fund. And the reason for that is that we still do have human underwriters. And so while we can pull data in and use Yodlee for bank statements and use LexisNexis and other data sources for trade credit, we still do place quite a bit of emphasis on our human underwriting, that's because of our line of credit. It's a constantly revolving product. We spend a lot of time with these borrowers. We want to make sure we're underwriting them intelligently on the front end.
Great. Well, let me ask the group another question. What tools are you using to determine credit risk on the loans that you're providing?
I'll start with that. It's interesting. I think we actually use a lot of the same data that traditional banks have been using for decades, if not longer. You're trying to understand the character of the business owner, the capacity of the business, what kind of revenue are they generating, what's the longevity of that business. We do that by getting access to a bunch of different data sources that our customers use to run their business. It could be their accounting data, it could be their payment processing data, shipping data, social data. If they're an online business, perhaps it's their online information or inventory management systems. So for us, it's all about being able to get the data from a third party without requiring the business owner to do anything. Because for us, the customer experience is not just about how long does it take us to make the decision, but how long does the customer have to spend getting data to give to us? Because it's one thing to say that it takes 24 hours. It's another thing to say, oh, but you business owner need to spend 12 hours getting data together that you may not really understand, and that it may not be exactly the right information that the lender needs.
That's a good point.
All right, I'll just add to that. What we do as well, it's once we bring this data in, whether it's through QuickBooks or banking data, we have algorithms that will figure out the ratios or look for loans that we may have to refinance. And all this feeds up, and of course all the credit score, and all this feeds up to a proprietary score, which we have. So our systems will pretty much tell our underwriters where this particular potential borrower ends up in our system and how fast we need to move on it. So we basically put them in 3 buckets. We have a green, which is a very good borrower. We want to close right away. Something orange in our system needs some work. It's a potential. And then, of course, red, there's some flags. We're not going to approve that. But that cuts down on a lot of time, and we can get back to customers very, very quickly.
One of the data sources that we use is actually tied to the line of credit. So one of the things that we've started doing over the past year is providing starter credit to our borrowers, and so giving them a smaller amount in a line of credit so that they can start to build up a history with us, so we can understand what their payment history looks like. If they don't have the payment history, we'll give them the line of credit to help them build that. That will then help us better assess whether they're eligible for a term loan or other products down the road.
Oh, very interesting. One thing I was wondering, and I know a lot of people, general consumers, are wondering this as well, do you provide SBA-backed loans, guaranteed loans by the SBA, Small Business Administration? If not, are you thinking of entering that market as a preferred lender?
We are not and do not plan to.
Okay.
Yeah, we have about 0 interest.
Okay.
And
I have a huge interest in it because I would love to have that low-cost capital. I think it'd be great to pass those savings on to the borrowers, but it's really hard to work within those confines. I know there are some companies who are doing it successfully. I wish we were one of them.
So we have SBA products on our platform. I mean, we are not the direct lender, but I think this whole SBA is an interesting discussion because the SBA, really has created this checklist of all the things that a lender needs to do to be able to get an SBA-backed loan. And many of those, the checklist of those items are very old school, and they're trying to create an SBA 1 to simplify and accelerate that process. But they've been talking about the SBA 1 for a really, 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 really long time, and it still hasn't come out. So it'll be interesting to see when that happens. I know there's lenders out there, smart biz, that have tried to simplify the application process for getting a loan, and it's still very painful and archaic and slow. So it would be beneficial to many non-bank lenders to be able to figure out to say, how can I get an SBA guarantee, because your cost of capital would certainly go down, as Kathryn has mentioned. But the innovation of a non-bank lender and kind of the SBA right now it's not mixing.
Right. Well, maybe that evolution will be coming.
Yeah, I would just jump back in just to say, too, about 25% of our borrowers have some type of SBA loan in place, but of course they're very restrictive and they need additional capital. So I think there are 2 types of borrowers, and even within a borrower that would take the 2 types of product, they use them for different things. So coming to us, they don't want that SBA experience.
One of the things that we've done is not just with SBA lenders, but with community development financial institutions, or CDFIs, is we've actually partnered alongside them. So the CDFIs are able to provide term loans, we're able to provide a line of credit, so we'll do a side-by-side line of credit with the CDFI. And so that's an instance where SBA financing can be complementary to the financing that we provide.
Right, it is also great for small businesses who are exporters and do international business, because having that credit backing sometimes helps them secure the foreign deal. So that's why it's a very interesting phenomenon. I'd like to also look and ask, how are you getting the word out about your company's products and services? A lot of people have a perception that marketplace lending is really for millennials, people that are very tech savvy. Maybe you can address that. How are you getting the word out about your offerings to the general public?
We're mostly broker-led for larger transactions, so average lending is probably about $600,000-$700,000 per transaction. Very definitely broker-led. And we don't have millennials as our core borrower.
Our core borrower isn't millennials either. Our core borrower is about 50 years old, or the owner is about 50 years old. The business is about 5 years old. And so what we have found, we're doing everything that everyone else on this panel is doing with pay-per-click and radio advertisement and whatnot. We've actually found that direct mail converts the best for us still. And so while we wish we were more innovative and had the most innovative solution to this, direct mail has been actually a great source of customer acquisition for us.
My co-founder and our CEO likes to say there are 1,000 shitty ways to acquire a small business customer, and you have to be good at all of them, and it's true. So we've really tried all the different things that you can find. But because we got our start making loans to online businesses on eBay, our core is online advertising and search engine marketing and SEO. So I think we spent a lot of time doing that and have gotten pretty decent at that. We're testing into other things like radio, which has been pretty successful. But I mean, the fact of the matter is a lot of small businesses are in the same places that consumers are. So you use a lot of the same channels to find them that you would anybody else.
We do a lot of what has been mentioned. One of the things that's worked really well for us is our partnership strategy. So our premier partner is Staples, and so business owners going to Staples or Staples.com or through any of for office supplies and things like that, and they're looking for a loan. We power Staples business loans, and we have something similar for LegalZoom and a couple other partners as well. And so the partnership strategy, in addition to everything else has been mentioned, has been good for us.
Great. How are you trying to develop a relationship with your small business borrowers? This is really key because we have a lot of companies entering the market, like PayPal, Intuit, Square.
So we spend a lot of time with our small business borrowers because of the line of credit product. So we're working with them every single week on their receivables, on their inventory as it turns. And so as soon as something goes wrong or as soon as a payment is missed, we've got a pretty close finger on the pulse of the businesses that we're working with. And so that's how we maintain the relationship with our borrower.
Anybody else want to address that?
I'll just jump in. So we do a fair number of partnerships also. So we spend a lot of time, whatever that partner may be, we spend a lot of time trying to understand their small business customers and how we can build a product around what they're looking for, depending upon why they're coming to that partner. So the more you can understand up front, the better you can serve them and structure a product. And then like Candace, I think we have a very high repeat rate. So if you get a customer, you have about an 80% chance they're going to take another loan out with you once they get closer if they're growing. So you want to treat them well and understand them while they're paying off. So if you have a good borrower, you want to spend good time once they get we go in about 2 or 3 months before the end of the term and see how they're doing. We'll even give them a call. Do you need another loan? Are you growing? Do you need more money? And make sure they stay with us.
One thing that's really cool that we're 2 years old now, so we have our first vintage, our first set of borrowers who are kind of terming out of their first product, which we never had a vintage before, so it's very exciting for us. And one of the things that we're finding really interesting is that our borrowers are great referral sources for new borrowers. Because our asset-based line of credit is based on invoices, the good majority of our clients are B2B small businesses, and so they have small business customers as well, and so that's quickly becoming one of our largest referral sources is our own borrower base.
Wonderful. Are you using social media to get the word out as well?
We spend a lot of time with social media. We have a tremendous number of followers on Facebook, for whatever that means, but we also use social data to augment our underwriting decisions. So it means that we understand how to find our customers on Facebook. Facebook is probably the best example. And it's funny, we recently had this campaign where the business that borrowed the billionth dollar that we put out was going to come to Atlanta and roll out the red carpet and all kinds of stuff. And we did that, and it was really cool because they started posting it on their Facebook page. It was this really interesting farm-to-table business in Seattle, and I actually thought we must have rigged it because they were the coolest company and really interesting, and I thought surely this couldn't just be the random company that we picked, but it was. And it was amazing how much more coverage we got via social because our customer was talking about it via social. It's been a great channel for us.
That's great. What are the issues your industry is facing today, and what do you think these issues will be 1 year from now?
So
Go ahead, Candace.
So I guess, the issue that when we first came to Crowdfinance a couple of years ago, the issue was fundraising. And everyone was saying, what do you get first, the customer or the money? And that was the topic we talked about. Last year at Crowdfinance, we talked about customer acquisition and how are we finding our customers and what's the new way to crack that nut. This year, the issue that we're dealing with at Dealstruck is less of a fun one, and it's an issue of stacking. A lot of the borrowers that are coming to us, they have to be a year old in order to be eligible for our product. And so in that first year that they've been in business, their financing options are very limited to extremely short-term financing options. And so a lot of our borrowers who have a revolving need for payroll or for inventory have been taking out daily debit loans or other types of products in order to fill that gap. Now they've taken 4 or 5 of them by the time they come to us. They've built that habit of taking a fixed short-term funding option for a revolving capital need. And so we spend quite a bit of time educating that borrower on why they need a revolving product and why it's not healthy to continue to take the multiple. We think that the short-term options are very important in a small business life cycle, and we certainly wouldn't say anything bad about them. However, once the business borrower takes several, they build a bad habit. And so then they take 1 on top of us, and then 2 on top of us, and then they put themselves into an event of potential default. And so it's an issue that is ever growing. 2 years ago, there was a debt consolidation company that said that 2 years ago they had less than 10% of the deals they were working out were due to stacking. Now 80% of the deals they're working out are due to the stacking issue. So that's something that we're really dealing with right now.
I agree with that. I think stacking is a systemic issue, and I've said before in other conferences, the problem with the stacking is that those that are doing the practice are not at these conferences or here in the conversation or discussing it. I will say, and the stacking is a problem because that borrower gets into this credit cycle, a never-ending credit cycle they can't get themselves out of. I will say that's different, though. Sometimes people confuse that with or the industry gets a bad rap sometimes for the high interest rate loans. And I think that there are some lenders out there that are predatory with high interest rate loans, but I think we need to not confuse the loan product or lender with the business practice. There are some higher interest rate loans that are that business owner, that's the only type of loan they can qualify for. And it's more about, are they educated? Is there transparency? Do they know what they're getting themselves into? And most importantly, does that borrower, can they get ROI from taking that loan? If they can't get ROI, then it's a bad loan product. We just recently did a survey. I think everyone knows that the Treasury's done this white paper or this RFI, request for information on the market. And we wanted to get real borrower data around, how valuable are some of these. We wanted to target a segment of higher interest rate or customers that have taken a higher interest rate loan. And one of the questions among many that we asked them was this was 6 months after taking a loan, how helpful was that loan to your business? And 85% of the business owners that took that loan said that the loan was very helpful. And then the next response down was somewhat helpful. If you included very helpful and somewhat helpful, it was 96% of the customers said that those loan products were very helpful or somewhat helpful to their business. And so just from an industry standpoint, I think sometimes we confuse high interest rate with bad practice, and I think that we need to separate those a little bit.
Mm-hmm. That's a good point. How do you see the SME lending market evolving, and how will marketplace lenders participate in the changes?
Yeah, you're looking at the industry, it's doubling and tripling every year. So I think we're going to continue to see that type of growth. And we're still at the very early stages. In our industry, we only have 2 public companies. As far as if you look at kind of the second tier of non-public companies in the industry, they're really just a handful with brand names. So there's still room for a lot of people, and we're dealing a lot with just how do you manage all of the growth. So the good news is, and everyone up here can attest to, there's a need for our product in the marketplace. We wouldn't have the type of growth that we've had over the last couple of years if there wasn't such a need. So hopefully we'll be here to fill that gap, and I only hope that the Treasury, after they get back all the comments, and I am hopeful just because if you read through the white paper, some of the comments, the questions were around how can they be helpful? How can they make the process more efficient for us? And I think there are some things they can do to make our lives a lot easier. Because the end goal here, and what we're all doing this for, is, hey, at the end of the day, it helps the country grow, right? We're really a country of small businesses, and to the extent we can efficiently get them access to capital they can afford, we're all better off as a country. So being the Treasury Department, there's a lot they can do to make that efficient, and hopefully we can take some pointers from my friends over at the UK, because if you look at what they've done, they've been very aggressive, even investing in some platforms, but very aggressive in addressing the situation and also being very, very helpful.
Stuart, maybe you can address that in more detail.
Yeah, I think I'm talking about it a little bit later as well, but yeah, the UK regulatory system has been very light touch, fortunately, so far. I think that's one of the big changes next year. It's going to get a bit more interesting because a lot of the firms in the UK are currently just interim permissioned, and they're beginning to go through full permission process. So I think we're going to see some interesting noise in the next 12 months. But the government is massively supportive of the industry. It sees it as a solution, not a problem, and everybody around it, whether it's Treasury or the regulator or anybody else, sees it the same way on the whole for now. And I think that's going to be the challenge, keeping it sensible whilst it's a fraction of the overall banking system, whether in the spotlight or in the shadows. I think the big opportunity in the UK, and it's no different here anywhere else in the world, is filling the gaps. Mm-hmm. Because all the changes in regulation of banks and their capital requirements is creating deep pools of problematic areas for funding for banks, which are too capital intensive, and they're backing out of it fast. SME lending is a very capital expensive part of the world for banks. So are overdraft facilities and those sorts of things. So there's a lot of opportunity for marketplace lenders if they can match their funding with their borrower requirements. Because I think there was a brief talk in the previous talk about the matching or otherwise of lender funding into borrower requirements. So we're matching the same term. We're lending out on 6 months and allowing people to withdraw their money on 1 month notice. These are the sort of interesting things we've got to watch out for. And I think marketplace lending has an opportunity here to rebalance everything, to have greater first loss position than banks with only a few % equity in play. Marketplace lenders, even if they're not balance sheet lenders, could have some skin in the game. It's not a big thing in the UK to have skin in the game because it's not part of the regulation at the moment. So balance sheet lending isn't really peer-to-peer lending in the UK at all. But there's a lot of changes. All I'm saying is those changes are where marketplace lenders are going to move first because it's path of least resistance to get scale.
Makes sense. Well, there's 13,000 marketplace lenders worldwide, and competition is really heating up in the marketplace. In the future, who do you think will be the winners and the losers in the marketplace?
Dealstruck's going to be a winner, of course. I don't know that we're going to speak to any losers.
Go ahead, Candace.
Well, and if anyone wants to jump in on winners and losers, please feel free. I don't know who wants to jump in on that, but just on the future of SMAs, if you don't mind,
Sure.
and the future of this marketplace, we're still relatively young. Kabbage is the oldest business up here at 5 years old, right? And so we're just now starting to see full first vintages. I think that two things are going to probably happen when we come back to Crowdfinance again next year. One of the things that we're starting to see is servicing is becoming very important. And workouts and understanding what's happening as these businesses are starting to run into their first issues. We've all been in a good economy for the past couple of years. Kabbage, you've seen more of the down economy than we have. But when we're starting to see stress on our businesses, servicing is going to be a very important topic, I think, in the coming year. And I think bank involvement. Mm-hmm. I think that, the banks have held back for the past couple of years for the most part, and we're starting to see a lot more interest from the banks now coming to us saying, can we buy your loans after they're a year old? Now, that's a much lower risk for us than coming in and underwriting them at the front end. And so I think that what you're going to see probably at next year's Crowdfinance is a panel of bankers who've now decided to get involved in the process and start buying loans at some point or another in this industry.
So more partnerships, perhaps consolidation? Do you think consolidation might be in the cards as well?
You have to figure that the preponderance of those 13,000 are relatively new and would have a difficult time, weathering any sort of economic storm. Depending on who you talk to, we've got 24 months in this cycle before bad things start to happen. Who knows what really comes of that. But I think it's going to be very hard without, a decent portfolio that you've demonstrated performance on to really make it through something like that. And the consolidation could occur, but are you buying technology? Are you buying a portfolio? Do you want to buy those assets that you didn't originate? I think that's all very complicated stuff. Kabbage is not a marketplace lender. We're a direct lender in the U.S. from an SME perspective. But I think what's really important is, flexibility. We're focused on diversity of funding, for example. So we have a securitization facility. We also are looking at a BDC. And, is there this marketplace option where you sell the loans? I think it's important just to have options to make it through whatever, we can't predict right now.
Excellent.
All right, I'll just jump in and, really, three things to focus on as you look at platforms. One, have they been able to attract institutional capital, both on the equity side and the debt side? And it's really within, I would say, 15 months of operation, you should have raised debt financing and, at least, $100 million. And then, of course, management team. Do they have great credit people? Do they have great underwriters? Start to look at who's actually underwriting, and then lastly, the technology. It's a real technology behind it. Are they making the process more efficient? If you've done that and you've been at it a couple of years, I think this is just a great chance of making it through a downturn.
I think the biggest question with all the marketplace lenders is what differentiation do you have? Being a marketplace, we have lenders approaching us every day because we see borrowers from SBA loans, equipment loans, real estate loans, lines of credit, and everything in between. And we have these lenders coming to us saying, hey, I'm a new lender. I want some, I'm hoping you can drive volume to me. And the first question we want to know is what differentiates you from anyone else? And why would we send volume to you versus the lender partners that we already are working with? And there's very few that really fill a niche. Mm-hmm. That very few that come up with something unique. And if they are unique, then we want to work with them because then they can help out a borrower that may not be able to get funded today. But there's a lot popping up because they look and they see headlines of raising capital or other milestones, and they think that it's simple. It's a difficult business model, and it's difficult to differentiate yourself. So I do believe there will be either fallout. Well, there'll definitely be fallout, but consolidation as well.
Well, thank you so much. I want to thank the panelists today, and I want to open up the floor for any questions. Anyone? Gentleman in the back?
Could you comment on what gross portfolio yield you're generating?
Repeat the question.
Can you comment on what portfolio yield
Gross portfolio yield
that your portfolio has been generating?
we can just generally say that on our products, our interest rates are all on an APR basis, and our APRs range from 10% to the mid-20s. Our average APR sits in the high teens.
All of our portfolios are secured, mostly property backed, and we yield today between 8 and 12, and historically 11% weighted. Pre-losses, pre-tax.
Oh, well, I'm more expensive. I can tell you what my price is, but my yield is different.
We won't speak about our yield.
Yeah, my average effective APR is in the low 40s.
Now, our APRs are in, I would say mid-30s.
And UK APRs are 8 to 15.
Okay, it's a little different.
I'm also a short-term lender, so every time my borrower pays me earlier, which happens with almost every customer, their APR goes up. So it's sort of this perverse
Yeah, our
logic.
short-term trade finance is about 30.
Anybody else?
I'll talk. It's actually better than you would think. So we don't really, everything's less than, I would say, 0.5%. So including, delinquencies. So we tend to, we don't, we have more of a more conservative product, if you can use that word in its type of space. So we don't, we have, our underwriting is, at least Candace is 1 year, we're 2 years in business. At a minimum, and we have our algorithms are really set to cash flow, so very, very low delinquencies and defaults.
I probably reserve about a little over 5 cents in every dollar that I loan.
And our vintage, as I've just mentioned, we just had our first vintage hit 2 years, so we aren't in a position yet to talk about defaults because we haven't had our portfolio around long enough to discuss that.
We've been going 2.5 years, and we have an effective weighted loss effect on capital of 0.4% per annum because we're secured.
Any other questions?
So obviously banks give the majority of SMB loans in the U.S. On what dimension do you think your business is? Do customers who choose you over banks, on what major dimension do you think they prefer this alternate product to a bank product?
I would argue that banks do not make most loans to SMBs, depending on how you define an SMB. If you're talking about an SMB as somebody who wants to borrow $1 million or less, then yes, perhaps that's true. But if you're looking for less than a couple $100,000, then banks have a very hard time serving that market. It's just not cost effective for them to originate that loan. It's a manual process. And frankly, their small business lenders are trying to book bigger loans because they've got goals to meet as well. So I'm not sure that's exactly an accurate characterization.
But for the small business owner who is eligible for a bank loan, we'll actually send them to the bank. So we have partnerships with upmarket lenders, and if we see a good credit and we think that borrower is going to be eligible, we'll actually promote them into a bank product.
And they'll come back after 30 days frustrated.
That's correct.
And then we'll serve them with our product. Yeah.
That's exactly right. We have all kinds of customers with bank lines, and they don't want to deal with it.
Yeah.
Yeah, and like I said too, about 25% of our borrowers have some type of SBA product in place, but it's very restrictive. It's rarely that you get a bank loan or SBA loan that will cover all your needs as a small business. So our product's been very helpful in companies that even have traditional financing.
Part of the survey we did, 55% of the borrowers went to their bank first looking for a loan, and it was a bad experience before coming. And so I'm not anti-bank, I just feel for what the borrower goes through, it's a painful experience currently.
Well, if there's no more questions, I want to thank the panelists. Thank you so much for your time.
Thank you, Lori.
We really appreciate it.